This week, the United States government is flooding the market with $119 billion in new debt. That includes $58 billion in 3-year notes, $39 billion in 10-year notes, and $22 billion in 30-year bonds. But here's the problem. There are serious signs that the world no longer wants to buy what America is selling. Foreign central banks are quietly shifting their strategy, and it's a warning sign. They are dumping long-term U.S. Treasury bonds and loading up on short-term Treasury bills instead. This means they no longer want to bet on America's long-term financial stability. T-bills mature in under a year and offer quick exits, while bonds lock in risk for decades. This sudden shift signals growing global fear about rising U.S. debt, inflation, and political dysfunction. As the U.S. prepares to sell $119 billion in debt this week, the world's biggest creditors are saying one thing loud and clear: they do not trust the long game. It gets even worse. Just last month, the U.S. Federal Reserve quietly stepped in and bought $43.6 billion worth of Treasury securities in just 4 days, without public announcement. This covert return to large-scale bond buying is raising alarms across financial circles. Analysts now suspect the Fed is being forced to prop up collapsing demand for U.S. debt. As the Treasury prepares to auction $119 billion in bonds this week, one question echoes loudly: who is actually willing to buy America's debt? If this week's auctions fail, it could trigger a chain reaction. Higher yields could crush the housing market, send interest rates soaring, and wipe out investor confidence in the dollar itself. This is not just a financial story. This is a trust crisis. The world is watching, and the clock is ticking. Before we get into the full analysis, don't forget to like, subscribe, and turn on notifications. First, let me explain why the Fed is secretly buying U.S. bonds. This really looks bad for the U.S. economy, but it is a lot worse when you dig deeper. You would not believe how much debt the United States has to offset this year. A total of $9.2 trillion in U.S. government debt is set to mature in 2025. Understand that this is not the total debt. The full figure stands closer to $36.9 trillion, but just the portion that needs to be rolled over or refinanced next year. In a normally functioning financial system, that would be manageable. But these are not normal times. Bond markets, which are traditionally the quiet giants of global finance, are now ringing loud alarms. In recent weeks, bond auctions have shown signs of slowing down. Yields are spiking. Foreign demand is low. And in a move that is both subtle and chilling, the U.S. Federal Reserve quietly stepped into the breach, buying $43.6 billion in treasuries over just 4 days. A silent resumption of quantitative easing without the name or the press release. This wasn't part of the Fed's standing repo facility or its traditional balance sheet adjustments. It was a deviation, a maneuver strongly resembling the early stages of quantitative easing, the controversial monetary stimulus program first employed during the 2008 financial crisis. But why no announcement? Because calling it QE would contradict the Fed's public stance of fighting inflation and tightening policy. It would also send a deeply troubling message: that the private sector no longer has the appetite to absorb U.S. debt at current prices, and the central bank is once again being forced to serve as buyer of last resort. It is not just the volume of debt that has unnerved investors. It is the sheer velocity of issuance, the declining quality of U.S. fiscal stewardship, and the realization that even America's bond market may not be the fortress it once was. Congress recently passed a $2.4 trillion tax and spend package, blending new stimulus, green energy credits, and expanded entitlements. Layered on top of that is America's chronic deficit problem. Over $1.6 trillion added to the debt this fiscal year alone. And we're not even at the finish line. In this environment, bond issuance isn't just a matter of funding new projects. It has become a difficult task, rolling over old debts while piling on new ones, in a market that's starting to balk. This isn't just a liquidity problem, it's a confidence problem. And confidence, once lost in the U.S. Treasury market, has increasing consequences for the entire global financial system. But why now? What changed? Recent Treasury auctions have been painful spectacles for seasoned observers. The 30-year bond auction saw dealers, essentially Wall Street intermediaries, absorb 18% of the issuance, the highest burden since 2021. This is usually a sign that end demand from pensions, insurers, or foreign buyers is fading. The yield jumped to 4.9%, the highest since before the Great Financial Crisis. Here is your original text with simplified grammar and easier-to-understand language. I've kept the tone and meaning the same. Likewise, the 20-year note auction had a bid-to-cover ratio of just 2.43, which is lower than usual. This ratio shows how much demand there is compared to how much is being sold. Lower numbers mean less interest. The 10-year note, often seen as a key global financial indicator, saw yields jump to 4.68%, with dealers again stepping in to buy up the leftovers. These results aren't random. They are signs of something bigger: investor fatigue. U.S. Treasury securities, which were once seen as the safest investments, are now being questioned. When yields go up, prices go down, causing losses for many investors. These weakening auction results reflect a deeper trend. Foreign investors are steadily pulling back from U.S. debt, reshaping the market landscape. Not long ago, foreign governments and central banks were eager to buy U.S. debt. Back in 2012, they owned over 50% of U.S. Treasuries. Today, that number has dropped to about 22 to 23%. There are several reasons for this. Rising costs to hedge currency risks have made dollar assets less appealing to European and Japanese buyers. Trade tensions with China and the U.S., using sanctions tied to the dollar, have pushed some countries to look elsewhere. And now that other countries offer better returns, many global investors are bringing their money back home. China, which used to be the second largest holder of U.S. debt, has cut back to just over $760 billion, the lowest level in more than 10 years, causing it to go down to third position. Japan is still the biggest holder but is also reducing its U.S. debt in favor of bonds at home as the interest rate gap shrinks. Now the U.S. will have to depend more on domestic investors. But their money is limited, and they want higher returns to keep buying. As foreign buyers retreat, the government faces the inevitable consequence. Borrowing costs begin to climb, putting more strain on the budget. As Treasury yields go up, so do the costs for the government to borrow money. The average interest rate the U.S. pays on its debt has jumped from 1.6% in 2021 to nearly 3.3% today. It's likely to go even higher as older, cheaper debt matures and is replaced with newer, more expensive bonds. At this pace, the U.S. will be paying more than $1.1 trillion a year in interest by 2026, more than what it spends on defense. In fact, interest costs will pass Medicaid spending by the end of this year. This is a risky cycle. The more we borrow, the more we owe in interest. The more we owe in interest, the less money is left for emergencies, public services, or investments. Even worse, rising Treasury yields push up borrowing costs for everyone else. Mortgage rates have already hit 7%, making it harder for people to buy homes. Car loans are getting more expensive. Companies are finding it harder to refinance their debts. High Treasury yields act like a heavy anchor, slowing down the whole economy even as inflation sticks around. Wondering who's pushing back? Look to the bond vigilantes. Once seen as a thing of the past, the so-called bond vigilantes, which are investors who protest bad fiscal policy by selling bonds and driving up yields, might be making a comeback. As inflation stays high and government spending continues unchecked, the bond market is starting to resist. The recent steepening of the yield curve, where long-term interest rates rise faster than short-term ones, shows a big shift in investor mood. They want more reward for the risk of holding U.S. debt for a long time. This is about doubts over America's long-term financial health. And when the bond market rebels, there's no easy fix. In the past, auctions of U.S. government bonds used to be routine and predictable events. They were often treated as simple administrative processes that quietly kept the country running. However, in the year 2025, These auctions have turned into highly stressful global moments that could have major consequences for the American economy, the value of the dollar, and the country's position in the financial world. These bond auctions have now become powerful indicators of how much the world still trusts the United States to manage its finances responsibly. The most worrying sign is that many investors are starting to lose interest in buying the longer-term 30-year bonds. According to reports from Reuters, the latest auction for these bonds did not go well. Fewer people showed up to buy them, and those who did demanded higher interest rates than expected, which clearly shows that they are becoming nervous. At this point, it is important to stop and ask a difficult question. What happens when the biggest risk facing the U.S. government is not the lack of money, but the loss of trust? With the bond market showing signs of weakness, the U.S. Federal Reserve now finds itself facing a very difficult choice. After months of trying to tighten monetary policy and reduce the size of its balance sheet, the Fed may be forced to step in and support the market again. According to sources from Reuters, officials at the Fed are already discussing emergency plans in case the auctions continue to fail. There is even a possibility of seeing the Fed resume quantitative easing by September. These plans include the possibility of pausing the current policy of quantitative tightening, reopening special lending facilities known as repo operations, or even restarting the direct purchase of government bonds. However, none of these actions comes without serious consequences. If the Fed chooses to support the bond market by buying bonds again, it could cause inflation to rise once more, especially since inflation has only recently started to come under control. On the other hand, if the Fed refuses to intervene, the bond market could collapse even further, and interest rates could shoot up to levels that would cause severe damage to the economy. In this way, the Federal Reserve is being pulled in two directions. It can either protect the bond market and risk its own credibility, or it can stay committed to controlling inflation and allow the market to suffer. The situation is so bad that Fed Chair Jerome Powell is saying the Fed would have to choose between dealing with unemployment and dealing with inflation. However, cutting rates while the government is struggling to sell its debt might look like a sign of weakness. Although such a move might help encourage more people to buy bonds, it could also cause the value of the US dollar to fall and send inflation expectations rising again. This leads us to a very troubling question. Will the Federal Reserve be forced to quietly take responsibility for fixing the debt situation, even if that means turning away from its main mission of fighting inflation? The problems in the bond market are not only the result of decisions made by the Federal Reserve. They are also being caused by the government's trade and tax policies, which have created more pressure on the economy. A major turning point happened in April during what the White House called Liberation Day, when new trade tariffs were imposed on goods from China as part of an ongoing economic conflict. These new tariffs were meant to punish China for its subsidies to the technology and energy industries, but they also had serious side effects. Stock markets around the world fell sharply, the prices of bonds dropped, and many investors pulled their money out of the US bond market. Eventually, the administration decided to pause its next round of planned tariffs, and this was not because of diplomacy or international negotiations. According to Bloomberg, the decision was made because officials were worried about how the bond market was reacting. In other words, the financial market had become so unstable that it began to influence national policy. This development is very concerning, as it shows that bond investors now have enough power to shape decisions made by the highest levels of government. It's worth asking, has the balance of power shifted so much that future presidents and Congress members will have to consider bond traders' demands before making major decisions? This isn't just about markets. It's about the very future of US economic sovereignty. The choices made now will echo for years to come. Stay tuned for more in-depth updates on this unfolding crisis. Make sure you're subscribed to get all the latest analysis as it happens.